Ever wondered how to measure the success of your investments? In the vast world of finance and investing, there's a handy tool that investors use to evaluate the efficiency of an investment. It's called ROI, an acronym for Return on Investment. This simple yet powerful concept is a ratio that compares the gain or loss made from an investment relative to its initial cost. Imagine ROI as a magnifying glass. It brings into focus the profitability of your investments. It can be your compass in the financial wilderness, pointing you towards investments that are likely to yield the best returns. It's not just about how much money you've made, but how effectively you've made it. Whether you're a seasoned investor or a beginner dipping your toes into the stock market, understanding ROI can be a game changer. It's like having a secret weapon in your investment arsenal. So, stay tuned if you want to understand how ROI can help you make informed decisions about your investments. What is ROI? It's not a catchy phrase from a pop song, but an important financial concept. ROI stands for Return on Investment. Imagine you're at a dinner party and someone asks, "So, how's your investment doing?" You could answer with a simple, "It's up by $5,000. That sounds impressive, right? But what if you had to invest $1 million to make that $5,000? Suddenly, it's not so impressive. That's where ROI comes in. ROI helps us measure the efficiency or profitability of an investment in a way that considers the amount of money we've put in. Let's break it down with an example. Imagine you've bought a property for $100,000. You've spent another $20,000 on renovations, and now you're selling it for $150,000. Your total investment is $120,000, and you've made a return of $30,000. But how do we express this as ROI? We take your return, in this case, $30,000, and divide it by your total investment, which is $120,000. This gives us a fraction, which we then multiply by 100 to get a percentage. So, in our example, we divide 30,000 by 120,000, which gives us 0.25. Multiply that by 100 and our ROI is 25%. This means that for every dollar we invested, we made back an extra 25 cents. You see, ROI simplifies the complex world of finance into a single, understandable figure. It's like a report card for your investment. It tells you how well or poorly your money is performing. And just like in school, a higher percentage is better. But remember, it's not just about the numbers. ROI is a tool, not a crystal ball. It gives you a snapshot of your investment's performance, but it doesn't predict the future. So, ROI gives you a percentage that shows the profitability of your investment. Now you might ask, how do I calculate ROI? Well, don't worry, it's not as daunting as it may seem. All you need is a bit of information, a dash of arithmetic, and voila, you'll have your ROI. Let's break it down step by step. Imagine you've invested in a small business. You've put in $10,000, hoping to see it grow and flourish. After 1 year, you decide to see how well your investment has done. You find out that your investment is now worth $15,000. That's a $5,000 return on your investment. But what does that mean in terms of ROI? Here's where the magic happens. To calculate ROI, we use a simple formula. It's the return on the investment minus the cost of the investment, all divided by the cost of the investment, then multiplied by 100 to give us a percentage. In this case, the return is $15,000 and the cost is $10,000. So, subtract the cost from the return, which gives us $5,000. Then divide that by the original cost, our $10,000. What we're left with is 0.5. Multiply that by 100, and our ROI is 50%. That's right, a 50% return on your investment. This means that for every dollar you invested, you made an additional 50 cents. Not bad, right? Now remember, ROI isn't just about the numbers, it's about understanding what those numbers mean. A high ROI means your investment is doing well, generating more money than it cost. On the other hand, a low or negative ROI indicates that your investment isn't performing as well as you'd like. So keep an eye on your ROI. It's a key indicator of how profitable your investments are and can help guide your future investment decisions. And that's it. As you can see, calculating ROI isn't rocket science. It's a simple formula that packs a lot of punch. Why is ROI, or return on investment, so important to investors and business people alike? You may have asked yourself this question before. The answer lies in the fact that ROI provides a clear, quantifiable measure of an investment's success. It's like a report card for your money, and who wouldn't want to know how their money is performing? Imagine you're an investor looking to put your money in stocks. You have two options. Company A, a tech startup with a promising new product, and company B, a well-established corporation in the manufacturing sector. How do you decide where to invest? This is where ROI comes into play. Let's say you decide to invest in company A. After a year, you earn a profit of 20% on your investment. That sounds great, right? But what if you had invested in company B and earned a 30% return instead? Suddenly, the 20% doesn't look as attractive. ROI allows you to compare these investment opportunities in a standardized way. By calculating the ROI for each option, you can directly compare the potential return and make an informed decision. It's not just about picking the company with the most hype or the biggest promises. It's about choosing the investment that brings the most value for your money. But ROI isn't just useful for choosing between investments. It also helps you measure the success of your current investments. If your ROI is high, that's a sign that your investment is performing well. If it's low, it might be time to reconsider your strategy. In the world of finance and investing, knowledge is power. And in this case, ROI is an essential part of that knowledge. It's a tool that helps you navigate the complex world of investing, making it easier to choose the right opportunities and measure your success. So, to answer the question, why is ROI so important? It's simple. ROI not only helps measure the success of your investment, but also helps in choosing the best investment opportunity. Like every good thing, ROI too has its limitations. Though it may seem like the perfect tool to evaluate investment options, it's important to understand that return on investment, or ROI, does have its flaws. One of the most significant limitations is that ROI doesn't factor in the time value of money. The concept of the time value of money states that money available now is worth more than the same amount in the future, due to its potential earning capacity. So, if you're comparing two investments, one that will return $100 in a year and another that will return the same amount in 5 years, ROI would treat them as equal. But clearly, faster returns are more desirable. Another limitation is that ROI doesn't account for risk. When you invest in a business, a stock, or a real estate property, there's always a degree of risk involved. Some investments are riskier than others, and ROI doesn't differentiate between them. Let's say you're comparing two investment opportunities. One is a stable, low-risk bond that yields a 5% return, and the other is a high-risk startup that could potentially yield a 20% return. ROI suggests that the startup is a better investment. However, the higher return of the startup also comes with a higher risk of loss, which ROI does not account for. Furthermore, ROI can be manipulated with different accounting methods. For instance, the calculation of net income and investment can vary, leading to different ROI values. Therefore, it's important not to rely solely on ROI when making investment decisions. In addition, ROI doesn't consider qualitative aspects such as the impact on the environment, employee satisfaction, or brand reputation. These factors, while difficult to quantify, can significantly impact the true return on an investment. While ROI is a useful tool, it's important to remember these limitations when making investment decisions. It's always wise to use a combination of financial metrics and qualitative assessments to get a comprehensive view of an investment's potential return. So, we've decoded ROI for you, but what's the takeaway? Let's recap. Return on investment, or ROI, is a crucial metric in finance and investing. It's a simple yet profound tool that helps investors measure the efficiency of an investment or compare the efficiency of several different investments. Remember how we calculated it? By taking the net profit of an investment, subtracting the cost, and then dividing by the cost. Simple, isn't it? But it's also powerful. It tells you how much bang you're getting for your buck. However, like all tools, it has its limitations. It doesn't consider the time value of money or risk factors. It's also not the only measurement you should rely on. So, don't put all your eggs in the ROI basket. Use it as one of many tools in your investment toolbox. Remember, ROI is a powerful tool, but it's just one of many that can help you measure the success of your investments.